Welcome to The Explainer. Today, we're talking about a revolution. But it's not happening in the streets, it's happening right inside your wallet. We're going to break down what a digital dollar could mean for you, the US, and really, the entire global economy.
So let's just kick things off with a question. We live in a world where you can get a car, a video, or a meal delivered to you almost instantly. So why on earth does sending money sometimes feel like it's stuck in the dial-up era? It can be slow, it can be expensive, and it just feels like our financial system is running on ancient hardware.
To really get where we're going, we first have to understand the money we use right now. And you might not even realize it, but there are basically three flavors of money. First, you've got central bank money. Think of a crisp dollar bill in your hand. It's the safest stuff out there because it's a direct IOU from the government. Then there's commercial bank money. That's the money in your checking or savings account. Super safe thanks to things like FDIC insurance. And finally, there's non-bank money. That's the balance sitting in your payment app. It's convenient, sure, but it also comes with the most risk and the fewest protections.
So the fix for our slow, clunky payment system might just be this new wave of digital money. The two big contenders on the scene are central bank digital currencies, we'll call them CBDCs, and stablecoins. Now, don't confuse these with the wild up and down cryptocurrencies you hear about. These are totally different. They're designed from the ground up to be stable, digital versions of good old-fashioned money.
Okay, so what is the United States actually planning to do about this? Well, the Federal Reserve is being very, very careful. Let's dig into what they're thinking, based on a major paper they put out back in 2022 that really lays out their whole perspective.
The Fed is basically the captain of the ship for the US economy. And when it comes to a digital dollar, their motto is slow and steady. They are not jumping on any bandwagons here. Nope. They are methodically, painstakingly weighing every single pro and con before they even think about making a move.
And this one quote from their paper really says it all. The Fed gets that this is not just another app or some minor tech upgrade. They see this as a once-in-a-generation, fundamental rewrite of the operating system of American money. It's a huge deal.
And here is the absolute key to understanding this. A digital dollar would be a direct liability of the Fed. What does that actually mean for you? Well, right now, the money in your bank is an IOU from that commercial bank. A digital dollar, though, that would be like holding a digital version of cash. It's a direct promise from the US government itself. No middleman. It would literally be the safest digital asset on the planet. So the Fed says if the US is going to do this, it has to follow four core principles. No exceptions. First, it's got to protect your privacy, but not so much that it becomes a tool for crime. Second, you'd still use your regular bank or payment app to access it, not some new government account. Third, it has to work everywhere for everyone seamlessly. And finally, you'd have to verify your identity to keep things in line with anti-money laundering rules.
Okay, let's zoom out. The Fed is looking at this from America's point of view, but the International Monetary Fund, the IMF, is looking at the giant global ripple effects. And when you change your perspective, a whole new set of risks comes into focus.
The IMF's whole job is to be the lifeguard for the entire global economy. So when they see a huge new wave like a digital dollar forming, they're not just thinking about how it hits one country. They're trying to figure out if it's going to cause a tsunami across the whole system. And what's their biggest worry? It's something called currency substitution. It sounds technical, but the idea is actually really simple. Just imagine you live in a country where the local currency is unstable and inflation is high. Suddenly, a super stable, easy-to-use digital US dollar is available right on your phone. What would you do? You'd probably start using it for everything.
And that's the danger. If millions of people in another country ditch their own currency for a digital dollar, their own central bank completely loses control. It's like trying to drive a car when someone else is holding the steering wheel. They can't fight inflation, they can't manage a crisis. It's a serious threat to their ability to run their own country.
I know this chart looks like a tangled web, but it perfectly illustrates that chain reaction the IMF is worried about. It shows how one little innovation over here can send shockwaves through the entire global financial system, hitting everything in its path. It just goes to show how deeply interconnected everything really is.
All right, enough with the high-level policy stuff. We've heard from the Fed, we've heard from the IMF, but what does any of this actually mean for you? Let's bring it back home and talk about the good news for your wallet.
So let's start with this number, 5.41%. According to the World Bank, that is the average cut that gets taken when someone sends a $200 payment from the US overseas. That is real money that should be going to families, but it's just getting eaten up by fees.
Now imagine that number dropping to almost zero. With a digital dollar, that's the promise. Sending money across borders could become as cheap and as instant as sending a text message. For millions of people, that's not just a small improvement, it is a total game changer.
And it doesn't even stop there. Imagine getting your tax refund the instant it's processed. Or if disaster strikes, getting relief funds in your digital wallet immediately. A digital dollar could also be a lifeline for the 5% of Americans who don't have a bank account. And it could unleash all sorts of new ideas, like programmable money that lets you pay a fraction of a penny to stream a song or read an article online.
But you knew there had to be a but, right? A change this big doesn't come for free. There are some really serious potential downsides that we absolutely have to talk about. Probably the biggest debate boils down to this central conflict: your privacy versus preventing crime. How do you possibly build a system that protects your personal transaction data from everyone, but is still transparent enough for authorities to track down criminals and terrorists? It is an incredibly tricky balancing act, and there are no easy answers.
And then you have this nightmare scenario, the digital bank run. Picture it, a financial crisis hits, people panic, and everyone wants to move their money to the safest place they can find. Well, what's safer than a digital dollar backed directly by the US government? Nothing. So you could see a mad dash as everyone tries to pull their money out of commercial banks all at once, potentially causing those banks to collapse.
Even without a full-blown crisis, there's a quieter, slower risk. What if a digital dollar just becomes a really popular place to save money? That could slowly drain deposits out of the banking system. And since banks use our deposits to give out loans, it could suddenly get more expensive for all of us to get a mortgage, a car loan, or for a small business to expand.
All right, let's pull back for one last big picture look. This whole revolution isn't just about faster payments or banking risks. This is about the future of the US dollar itself and America's role on the world stage.
You see, the US isn't operating in a bubble. Dozens of countries are already experimenting with, and in some cases, have already launched their own digital currencies. And the Federal Reserve made a critical point. If the rest of the world adopts faster, more efficient digital money and the US stands still, the dollar's status as the world's #1 currency could be at risk. A US CBDC might be necessary not to get ahead, but just to keep from falling behind. And all of this brings us to one final huge question that hangs over this entire transformation. As we completely redesign money for a new era, what kind of future are we actually building? Is it one of ultimate financial freedom and convenience? Or are we, maybe accidentally, building the tools for total centralized control? The final chapter hasn't been written yet, and the answer will depend on the very choices being made right now.